Recording. AI प्रेजेंटेशन करना होता है लेकिन साइड से वीडियो बंद करना पड़ेगा किया Is your portfolio future ready?
Hi, good evening, everyone. We'll be just waiting for 5 more minutes before we start the webinar, and the webinar will be a short webinar, so I won't take much time. I'll speak to the point on some very important data. Just we'll just wait for 3 to 4 minutes more. Hello, good evening, everyone. Can someone confirm whether I can be heard clearly?
Yes, you can be. We can hear
Yeah.
you.
Okay. Yeah. Thank you, Sadasivan. Thank you. So
Yeah, we can hear.
thank you, thank you, thank you. So do mute your microphones, and I will keep this webinar short. I won't take much time, but there were some important data points which I felt that I should share with as many people as possible, especially all those who are connected with us and are investing through us. So a webinar was a better way to reach out to a lot more people. If I start talking on people one-to-one basis, it would be very difficult for me to reach out to everyone. So we are also doing a recording of this webinar, so those who miss out will be able to get the content. Okay, so how many of you have been worried about not getting any returns in the market? You have been checking your portfolio at least once a week, whether it is going up. Have you been doing that? You can raise a hand if you have been doing that. it happens because I get calls. So the reason I thought that let me do webinar because there were people who were calling me. They were worried that the mutual fund portfolio is not moving. It is as it is there for the last 1.5 year, and they had questions and they were asking what is happening, what should we do. Okay, so I know we have seen lot of these good phases and bad phases in the market. When the market does well, people say, "Arey, I knew the market would perform, it would give returns." But when the markets don't do well, people ask me, "What will happen? What do you think? Will our money recover or not? Will it make returns or not?" Okay, so let's look whether this a very very important point, is your portfolio future ready. Now I am not saying at all that I am able to predict the future. That is not what I am saying. No one can predict the future, especially when it comes to investments. So in returns, we will always hear the word expected returns. But when it comes to risk, you will never hear the word expected risk because risk can never be expected. It is always unexpected. Okay, so but though we cannot predict the risk and it happens in very unexpected manner, but there are certain things that we can do in order to be prepared if something unexpected happens. So, so I will be touching on that point, very important principles. In fact, some of you are already aware of this because I have had one-to-one interactions and we have been working on your portfolio on those principles. For those who have not, we will get in touch, or you can get in touch with us, and we can do what needs to be done to get your portfolio future ready. Okay, so before that, let's look at some data points. So now, what we are going to do, we are going to look at last 25 years of things that have happened in all over the world. Okay, so in the last 25 years, we have had at least sorry, uh, we have had at least 12 major conflicts. So 12 major conflicts. And what has been the effect of these major conflicts since 2000? Uh, Especially on the Indian market, on an average, the conflicts have resulted in a drop of around 18%. Okay, whenever conflicts have happened, it has on an average, sometimes it has been 24%, 30% also, but on an average, whenever conflicts have happened, whenever wars have erupted, the markets, Indian markets, especially the Nifty index, has gone down by, on an average, by 18%. Currently, based on the January 26 data, Nifty is down by 10%. Okay, around 10%. It is still around that level. So now what we are going to do is we are going to actually look at some important data here. So from in the last 25 years, average fall after a war has been minus 18.7%. Now, whenever a war has erupted, usually the market has been wherever it is, from that point when it fell. Okay, so how many days did it fall? So in some cases, it was more than 100 days. But on an average, the time taken for fall from the top, at the peak, at the highest level of the market at the time of the war, to the bottom was around 95 days. Okay, so the average number of days was 95 days. Now, after the fall, how much time did it take to recover? So after the fall, it has taken an average of around 374 days, means around 1 year to recover. Now, whenever this has happened in the last 25 years, this is basically concerning wars. Whenever this has happened, the next 1 year, the market has given 32%. If the investor has stayed on after the war for 3 year more, the market has delivered 20% CAGR. If the investor have stayed on for 5 year more, it has generated around 17% CAGR. So when we look at what has happened in the market, especially during wars, this, we can take comfort because we have to learn lessons from history. A lot can be learned. Okay, so this is very important. We have already had, so we are at the bottom. So if we look at this data, definitely we can say that the next 1 year, 3 year, 5 year returns, probability is very high that we will have positive returns. Now, this particular war has resulted in the crude oil spike hikes. Okay, so since 2000, there has been many times. This is not the first time crude oil prices have gone up, and people are worried about that. Uh, but crude oil prices, if we look at 8 instances of crude oil price hikes, at that point, average has been around 154%. There have been crude oil price hikes in the range of 200 and even 300%. Just imagine, we have not yet touched that stage. But whenever crude oil price has risen in the international market, due to any reason, not just war, but due to any other reason, the government has always passed on that hike in a very phased manner. It has not been suddenly passed on. All governments have acted that way. So 154% rise in crude oil prices, but retail prices on an average has risen only by 10%. I'm talking about all past 8 instances. So can you see there's a huge difference in the actual crude oil price hike and the effect passed on to the retailers. Okay, so government has been able to absorb. Now here there was some news about the government of India selling gold in the international market, around 1 lakh crore of gold being sold, value of gold being sold. So, I have been following the data on gold also. Since the Russia-Ukraine war, that was around 3 years back, India has actually been one of the buyers of gold. Okay, so what we did was when the Russia-Ukraine war erupted, India, China, Turkey, and few other nations were actually buying gold. That was at that time gold prices were much lower. So last 3 years, India has bought lot of gold reserves, and selling a part of that reserve is not something to panic about. It is actually they are selling at a higher price and doing some profit booking. In fact, analysts are expecting that some more nations may actually sell their gold at these prices to make some profits. Okay, so I don't think that is an area of concern, India selling its gold. Now, let's look at apart from now, we have seen war, effect of war, we have seen oil price hike, but there were other events other than the gold price, other than the wars and oil price hike, which had significantly impacted the market. Now, I have made a list of these events. Okay, so in 86, 87, there was a recession, global, not just in India, all over the world. There was a huge recession. But before the recession, the market performed extremely well. So this column is for what happened before the recession came or before the market started falling. So you see in all this crisis, 86, 88, 1991, India went through financial crisis. Then we had the Harshad Mehta scam, which affected the stock market. But look at the returns made every year. 94, 96, we had the bubble stock market. Then we had the dot-com bubble in 1921. Then we had the Lehman crisis in 2008. Before all these major, and then we had COVID. Okay, so before all these major events hit, the markets gave very good returns, very good, excellent returns. But after these crises happened, global events happened, look at the kind of fall the market had. 41%, 38. Harshad Mehta market fell down 54%, 40%, 56, 60, 38. Especially, I think, we should pay attention to COVID because this was a very, very different type of event which the world faced. In fact, I too went into that mentality and I was so doubtful whether we will come out of this problem and when we will come out. It looked as if everything was collapsing. There was no hope of a normal life, people coming back to work. The virus was just spreading, panic was spreading, but yet we recovered from this crisis. And I remember a particular article after COVID, lockdowns were lifted gradually, and full-fledged. This has not started. Many corporates were still working from home, but gradually the lockdowns had started. And I read this news, report about SUV sales. As soon as normalcy returned, people were buying SUVs. So each of these crises were different in nature. Now, after this crisis, look at what happened in the market. The next 3 years of the market were very, very good. They people people did make money, investors did make money after the crisis. Each of this crisis was very different in nature. None of them, no one expected this crisis. No one predicted this crisis. It just came. Each of this crisis, created fear. And it is this fear that because of the fear and the panic that sets in, the market starts going down. Okay. So, the people who really benefit from fear are the news channels because that is one business which thrives on fear. But when it comes to investments, those who do not fear, those who do not panic, they are the ones who make money. So people who panicked here and started withdrawing their investments thinking everything was over, they really made losses. But those who did not fear, those who were calm and who just knew that this was a temporary phase, they just believed they got to see this results. Okay. So when we look at this data, it is very, very clear that no matter what wars happen, no matter what events happen, no matter even if crude oil prices go to 200 or 300%, India has been able to absorb those impacts and definitely come out of it. But the problem is, when fear happens, people start taking decisions based on the last event. Okay, so for example, uh, if uh, if the markets are down, then investors start thinking, oh, what should we do? Should we move somewhere else? Because markets are not giving, returns. So there was this friend of mine who, sorry. So I heard this, real incident narrated by a person. He's a Gujarati and he was telling me this person has happens to be a fund manager with a reputed AMC. So this person, he was telling one of the incidents that he happened to say. So in Gujarat, so he had a friend who had an apartment in one of the top floors of the building. So in Gujarat, incidents of earthquakes have happened, and he had bought this apartment because he wanted the view and all that. And following year after buying, the following year there was an earthquake. So when the earthquake happened, he was really, really rattled. So he said, what, I bought an apartment in one of the top floors and this earthquake happened. So he had a change of mind. He said, now earlier I had bought the apartment because I wanted some breeze and air. But after the earthquake, he changed his mind. He felt, going lower is much, much better, having a house, on the lower floors. So what he did was he sold his apartment and then he moved. Kindly put your microphones off, please. Uh, so then he sold his apartment and he bought an apartment on the ground floor of another building. Now, when he moved into the ground floor of that building, what happened was next year floods hit the place where he had bought the apartment. So, this is how now what is supposed now his ground floor apartment is flooded with water. Now, what should he do? From there, what should he buy? A boat. So this is how, many times, this is how we behave when it comes to when markets are not doing well, we think, oh, FDs, let's move to FDs or something fixed. But when we go there, we put our money there, and then we see markets are doing well, then we come back here. So in order to avoid all that, is there a way which we can manage our portfolio properly without getting into this kind of panic behavior? Because ultimately, more than market risk, what data and study shows is that investor behavior also has a very important role to play in creating wealth. And the reason I'm sharing these data is because we need to see some facts. And when we see facts, then our mind, I think, will relax more and know what we are supposed to do. So when we look at all these three data that I have shared, one thing is very clear that after every war, after every event, even after oil prices have spiked up, the market, these incidents have affected the market, no doubt. But after every market going down, it has always recovered. Okay. So now here what we need to do is we do not know what will be the next crisis that will hit. But is there a way that we can be prepared in order to better absorb if there is another crisis that comes, an unexpected risk that turns up? Let's see what we can do. Okay. So currently, where are we now? I want to take you to I want to take you to the Sensex. I'll show you. Okay. So here is the last 5-year chart of how the Bombay Stock Exchange Sensex has been moving. We see here in September 24, this peak of the market is September 2024. At this point of time, what happened was the results of the companies did not meet the expectation of the market. So the market was expecting more profit growth in the profits, but the results that came out showed that the profits were not up to expectation. So the market started tumbling, and a lot of foreign institutional investors withdrew money and they invested in other countries. Now, this has happened earlier also. This is very normal. Foreign investors have left Indian markets earlier also, and they have come back when it has become lucrative. So now from this point, this is September 2004 here, so after bad results, the market was recovering here. But then again, tariffs started. After taking hit of the tariff, we see again markets recovering here. But then war hit, Iran-US war. So we are seeing that, after every fall, the market is recovering, but another event is happening here. Okay. So now it's almost 2 years that the market has not crossed the peak. So we are very close to the time when markets will again cross this peak. Now, in this last 2 years, what has also happened is that stocks have become cheaper compared to what it was earlier. And 2 years, the companies have got to improve their performance. And the stock prices did not rise in these 2 years. So now what has happened in the market is that the stock prices are now in alignment with the company profits. So the chances of a recovery in the markets are very high. I honestly, I do not know when the recovery will happen, whether it will happen now in 6 months or it will happen in one year. No one can predict that. but we can only look at data. And when it comes to investments, we can only talk in terms of probability. Okay. So this is where we stand currently. Okay. So what should we do in order to be future ready? One of the best principles to be future ready is the principle of multi-asset allocation. So there was this person called Harry Markowitz, who also won a Nobel Prize for his study between risk and reward. One of the findings of his study was that uh, how you distribute your money or how you allocate your money between different asset classes, that is the most important that has the most important or most impact on your wealth. So, his study proved that people who managed their allocation or distribution of money properly between different asset classes, between equity, between fixed income, between gold, between real estate, they are the ones who were able to manage and grow their money in a more impactful and steady way. Out your money can change. So for probably a young family or family with a good risk appetite, they can be from 60 to 70. The whole idea is that don't put all your money in one place or in one type of investment. Don't put all your eggs in one basket. The If 60% goes here, then 30% should be in fixed income. Now, in fixed income, there are good opportunities in bonds, debentures, stable. There are lots of solutions that gives you safe, stable returns. And then gold is also an asset class. It's a long-term asset class, just like mutual funds. It will also give negative returns. So do not invest in gold thinking that, in next year or within 1 year or 2 year, you will make a lot of money. No one can predict gold movement. In fact, it is more difficult to predict gold movement because there is absolutely no formula. There are different viewpoints on when gold will increase, but there is no universal agreement on one type of formula. Whereas in equity, there are lots of ways one can calculate and have some reasonable understanding of what kind of growth you can expect in the market. Okay, so uh, having some investment in gold is very, very important. Currently, we are only suggesting 10% investment in gold, and the remaining 90% based on the family, one can distribute it as per the family's needs or in what stage they are. When we do this distribution, it will look something like this. This is what we have created for people for whom we are managing. So we are doing this is called family balance sheet. So everyone should have or you should know your family balance sheet, how your balance sheet is. Okay, so this is called the family balance sheet. So basically, you should know how much percentage of your money is in fixed income. Fixed income is wherever you are getting fixed returns. Okay, it could be your provident fund, it could be fixed deposit, it could be PPF, Sukanya, insurance policies. Equity is all your mutual funds. If you have a portfolio management system or if you have any other product, direct shares, all that will come under equity. When it comes to gold, I'm not talking about gold jewelry. I'm only talking about gold as an investment. If you have done gold mutual funds or gold ETFs, only that we count here. So you see in this particular example, this family has around 1% in gold, 32% in equity, 27% in fixed income, and around 39% in fixed assets. In fixed assets, we have taken house, jewelry, and shares. Jewelry and shares basically a family buys for not for selling, it is for passing on to the next generation. So getting this asset allocation proper is very, very important. So my first suggestion would be that, get to know how your wealth or how your money is spread out. This is most important. If you spread out, now what happens is now this person has around 32% in mutual funds or equity, but he also has around 27%. So even if this money has not performed in the last 2 years, this money is giving him steady returns for the last 2 years. So you see, it balances out when you have spread out your money. There are years when markets don't do well, but golds run. Okay, gold does very well. So if you have some allocation to gold, that is also very, very important. Now, okay. Now, again, when if we take it further, so you have allocation to equity. Uh, so you have allocation to equity, but even in the equity, you can have diversification. So you can have mutual funds. You can have other products like alternate investment funds. If you are expert or you take expert opinion, you can invest directly in shares. Then in equity, you also have unlisted shares. Please don't get into unlisted shares unless you have a very good knowledge or very good guidance are very, very risky. But all I'm saying is the point that I'm making is diversification is very important. Again, within mutual funds, your money should be properly diversified between the different. There are various categories of mutual fund schemes available. So, and which category to take and what you should have in your portfolio, that will all depend case to case. It will be different. So these are just examples I have put up. They are not suggestions at all. I am only here. The point that I'm trying to make is that you need to diversify. So in this unlisted segment, yes, you can invest in early stage companies, mid growth stage companies, and also pre-IPO stage companies. So in equity itself, there is so much diversification available. Now, if you look at fixed income, again, fixed income, there are so many diversifications and all are important. Say, provident fund, PPF, bonds, debentures, guaranteed incomes, Sukanyas, FDs, they all have a purpose. And again, family to family, where you should put, what you should take, where you should keep your money, how long you should keep your money, everything will change. But the whole idea is that diversification is very, very important. There are more diversifications you can look into. There are REITs, REITs, REITs. Salvis, put your microphone off, please. So there are REITs, REITs, where the money gets invested in real estate. Then there are InvITs, where the money gets invested in government infrastructure. They also give steady returns. Okay, so there is lots of options available for diversification. What also every equity portfolio should have is you should have a plan B in your portfolio. What is plan B? So mostly when people invest in mutual funds, the investment relies on only on one thing, that the market will go up. So if the market goes up, the mutual fund portfolio does well. But if the market doesn't go up, then the mutual fund portfolio does not perform. So we know from experience, most of you have already experienced that the market will not go up every year. There will be times when the market will go down, it will be negative, and there will be times when the market will be slow, and you will wonder, my FD is giving more returns than the market. So if the portfolio is dependent only on one thing, that the market should go up, then this is plan A. But if you have a plan B, what if the market goes down? What if the market gives a single digit return, not much return, 4%, 5%. So is there a plan B in your market? So what one can do is at least have a small portion of your mutual fund, whatever amount you have in mutual fund, a small portion of mutual fund should be in plan B. Now, there is a new category of mutual fund that has been launched. It is called SIF, Special Investment Funds. I am not going to talk much here, but these special investments funds have been created specially for these kind of situations that we are going through when the markets go down, when the market does not give returns. In these scenarios, also the special investment funds will perform much better than the regular funds. So this is a totally new category that has been created. It's a very new category. Not many people know about it. Minimum investment in this, first investment in this fund is 10 lakh. After that, one can do an SIP of 1,000 also. And there are within SIFs also, there are lots of different types of SIFs available, keeping different objectives in mind. So one can have a plan B through SIF, or one can have a plan B through market linked debentures. Okay, so maybe some of you have heard of market linked debentures and some have not. So in short form, they are called MLDs, market linked debentures. So there is a whenever there is a debenture, there is an issuer. Usually the issuer is a finance company. The major players in the market linked debenture space in India is Anand Rathi and Nuvama, or which is which was Edelweiss earlier. So these are the two, but they are very interesting, and probably you should also have a look at market linked debentures. I'll just share with you example of Nuvama market linked debenture where minimum investment is around 5 lakh. So the debenture is linked to the market. Depending on how the market moves, the debenture will give you return. That is why it is called market linked debenture. Now, what it says is that if it has conditions for all the things that can happen in the market. So condition one is that the market can go down. Okay, so the debentures are for 3.5 years, Nuvama debenture. And it says that if you take this debenture and in the next 3.5 year, market goes down, which means market goes negative. No matter how negative it may go -10, it may go -50, it may go -100. -100 will never happen. But whether it goes -10 or -50, Nuvama says, I will give you 100% protection on your capital. So your capital will remain intact. No loss on capital, even when market goes down. So now what happens if the market goes up? So basically the debenture is plan B for those times when market will not perform. So on those times when market will give very less returns like 4%, 5% or 9% or 10% returns in 3.5 years. So what Nuvama says is that no matter how much they give, I will give you 5 times more, 5x. But maximum I will give is 50%. Okay. So for example, if in 3.5 years, market gives only 1%, then Nuvama debenture will give 5%. If in the next 3.5 years, market gives 10%, Nuvama debenture will give 50%. What happens if the market gives 20%? Nuvama will give still 50% because 50% is the capping. Okay. So these debentures are plan B for those phases in the market when the market does not do well. Okay. So the whole idea of today's webinar was this: the webinar is not for outsiders. It is basically only for people who are already associated with us. So it is our duty to always keep them updated about what is happening. Because of a few phone calls also I received, they were concerned. They were new investors. They had not seen these kind of things. So I thought, why not reach out and why not show people data? Cyril, could you just mute your mic, please? So why don't, why not I show them data? And because when we see data, then people understand more. And what I've tried to do is I have taken this data from research notes of Anand Rathi and NSE, and I've compiled this data and tried to make it just very simple for you. So there are two, three things that you need to do to be future ready. One is ensure your family level balance sheet is done properly so that your money is spread out, and even when markets are not doing well, at least some portion of your money is earning for you. So family balance sheet is a very important thing to get it done. The second thing is remain invested. Very important thing. Remain invested. I have shown you data how after markets have not done well, markets have always recovered. That is a big lesson here. No matter what event has happened, all the events were unpredictable. But after the events happened, markets have recovered. So remain invested. There is no need to panic. It is very, very important to get your portfolio reviewed. We are now doing portfolio reviews with a lot of people. So if your portfolio is not reviewed, do get in touch with us. We will review your portfolio. When we do portfolio reviews, we are looking for some important parameters like you may have 5 schemes, you may have 10 schemes, you may have 14 schemes, but how much of your money is going into large cap companies and mid cap companies and small cap companies. How much of what we are trying to do is we are trying to do the reviews and ensure that you have at least around 50 to 60% exposure to large cap, because the data shows that large caps are very good to buy now. And whenever the market recovers, the first recovery you will see happening in the large cap. So certain categories like large cap category, the index category, the flexi cap categories, which have more top 100 companies in their schemes, these schemes will do well in the initial phase when the markets are recovering, and later on we will see recovery in mid and small cap also. Okay, so remain invested and get your portfolio reviewed. Uh, Diversify into other assets. Hope at the family level balance sheet, ensure that you have not put all your eggs in one basket. There are lots of exciting options. We are living at a time when we have lots of options which give steady returns, and always stick to the regulated sector. Do not put your money outside or through apps which are not SEBI regulated. Probably all of you are getting messages on your phones also to beware of scams. So please follow this rule that only put your money where it is regulated. And You can also look at having Plan B in your portfolio, which is SIF, specialized investment funds, and market-linked debentures. Market-linked debentures give you 100% protection on the when market goes down. Specialized investment funds also give you good protection when the markets are going down, but they still go negative. But compared to the market, they go very less negative. Okay. So as I said, promise, I have kept my webinar very short and to the point. We can open up the webinar now for questions. So if you have any questions, we can look into that. Yeah. So any feel free to ask questions. I know uh, maybe or if you don't want to speak into the mic, you can probably just type a message and we will we will be happy to answer that. Saisha, any questions?
No, no, brother. I'm very new into this investment, so I was just listening to understand. But
Uh,
definitely, if I have anything, I will connect with you.
I hope it was simple. If there are some part, if you did not understand, do feel free to give me your feedback, because then I will improve on that also. I will try to, because my whole intention is always to speak in very simple language. I'm trying my best to bring down these concepts in simple
Yes,
language.
yes, yes, brother. It was a very beautiful session, though.
Thank you, thank you. Any questions? I can see Rohit. Rohit, you are there. Rohit, any questions?
Uh, no, Augustine, it's all good. It was very
Rohit,
good.
by the way, Rohit is an expert in the markets. He is, in fact, a forensic analyst, no, Rohit? And he catches frauds in the market. He is our relative. So I'm happy to have you, Rohit. Thank you for coming. Rohit, your
Mm,
feedback, I just kept it simple. My whole point was to give some data points to help investors to ease their nerves. My whole message was, don't worry, this has happened earlier. and this is just a phase. Did you get the
Yeah.
whole this, or you were late?
No, I was there. It was very well explained, and the message is important to remain invested. That's a good message.
Thank you. Nice to have you here.
Nice to be
Hi,
here.
Agustin. How are you?
Hi, Praveen.
Yeah, yeah.
Uh,
And
yeah.
it's a good thing, we could attend this because this was something in going back in my head that what will
Huh.
happen, especially with this BCC people. Yeah.
No, no. But I think
Yeah.
even the war it's just a matter of time. The war will get over. And one thing about wars which we have now, see Russia-Ukraine war. Okay, when the Russia-Ukraine war started,
Mm.
the markets reacted. I think it fell around 30% because
Yeah.
of now it's third or fourth year. War is still going on.
Yeah.
War is not stopped. But what has happened is that the market has now stopped reacting to Russia-Ukraine war. It is reacting to the Iran war and oil price high. So after some time, no, the market adjusts and it moves forward.
Yeah. Anyway, I'll just connect with you regarding this family balance sheet. So,
Yeah. We have upgraded our format of reports, no? So
okay.
I think when we did this with you, that time this concept was not there, family balance sheet. But this is something we keep on improving. So, and in
Yeah.
today's time, it's very, very important to have this balance.
Yeah. Okay, Agustin. Thank you.
Thank you, Praveen. Any questions? Any more questions? Okay, so I think we will call it a day. Thank you for taking time out and attending this webinar. Uh, if as I said, you want to get your family balance sheet done, get in touch with us. Most of you are already with us. In fact, all of you are already with us. If we have not done this for you, get connected. We will do the family balance sheet. Also, reviews are going on. For those who are already on Anandati platform, we have a system of model portfolio and timely reviews. But those who are on Fund Bazaar platform, we get in touch with them and we do the reviews for them based on research inputs. Okay. So thank you and have a nice evening. Bye.
Thank you so much,
Bye.
Augustine.
Thank you so much.
Thank
Bye bye.
you. Thank you. Thank you.
Bye bye.